Hey everyone, it's Jeremiah Taylor, Chief Real Estate Officer here at Movoto, and I want to take a moment today to explain how the Federal Reserve, or the Fed, impacts mortgage rates. It's something that sometimes can be a little bit confusing, but it's actually pretty straightforward once you break it all down. So you see, when the Fed raises or cuts interest rates, they do that based on whatever's going on in the economy. When the economy is growing too fast, inflation is getting out of hand, the Fed may actually raise those interest rates to slow things down. Now, on the other hand, if the economy is struggling, things are slow, the Fed may cut those rates to encourage more spending and more borrowing. What they're doing is they're using the interest rate to increase and decrease the effective monetary supply, or the amount of capital in the markets. Now, you may wonder, how exactly does that connect to mortgage rates? We see when the Fed raises or lowers its benchmark rate, it directly impacts short-term interest rates, but it also influences long-term rates, specifically the 10-year Treasury yield. Now, mortgage rates tend to fairly closely follow that 10-year Treasury yield because investors often see them both as safe long-term investments. So typically, mortgage rates are somewhere between 1.5 and 2 points above that 10-year Treasury yield. And in times of uncertainty, that spread may go a little bit further apart. And when things are getting better and people are more ambitious, that spread may get a little bit lower, even lower than 1.5. So that's to say, when Treasury yields rise, mortgage rates tend to rise. And when they fall, mortgage rates usually fall too. But it's important to note, mortgage rates aren't just influenced by the Fed. Other factors like inflation, the housing market, investor demand for mortgage-backed securities all play a role. So while the Fed has a big impact, it's very much part of a larger picture. Hopefully that clears things up a bit for you. At the end of the day, the Fed's moves influence the broader financial markets. And in turn, those impact you and the rate you get as a borrower when shopping for a mortgage. Now, the most important thing is to talk to a local mortgage and real estate professional about your situation in your local market, because at the end of the day, that's what matters the most.